if you do trade cheap charts like these down in the sub $10 or $15 category, they better dang well have this kind of a chart pattern where you've got a nice multi-week continuation that's nice and well-mannered and well-behaved. This is CDE. This is a great chart. I don't know if I'm killing the pronunciation, but core mining. Anyway, those have been moving nicely. Here's Hawaiian Electric, HE. Aloha to this one. Went all the way from 28 to 34 before running into overhead resistance with a shooting star, or at least a gravestone doji up here. We have a nice large momentum candle starting to stall. What you want to look for are these kind of charts that have a decent base and continue their way up with minimal pullbacks that have, you know, the less the pullbacks, the better. The closer the chart looks like or resembles this chart, the more money you can make, potentially. The more the chart is plagued by trouble and has pullbacks, the less you should trade the chart. Keep everything you do. I'm a professional price action trader. I've traded as much as 4.1 million in trades in a single year. I know how to trade. I'm a good trader. Well, the thing is, it took me 2 blown accounts and hundreds, if not thousands of mistakes I've made in my early years back in the 90s, and to get to be a good trader, one of the things you really need to do is make sure that you know the difference between perfect success charts and everything else, and have that firmly in mind. And just because some ding-dong educator, blowhard, who doesn't even really trade like a lot of my competitors are out there touting stuff on a forum or a message board or a chat room or whatnot, don't take the trade. Be skeptical. Instead, only focus your energy on the strongest price action momentum charts like these that actually have a shot. Here's another cheapie for those of you who trade the cheap instruments, IAG. If you do trade inexpensive instruments, they should be like this, not the ones that these penny stock speculator bad people try and tell you to trade. Oh, it's short a penny stock, and then you get blown out of the water and your account gets closed and you get a margin call and you end up owing your broker $8,000 because your short attempt went far against you. Of course, the educators out there in that market space don't tell you about that. The truth is, the cheaper the chart, the more dangerous the chart. On the flip side, expensive charts offer poor leverage, so that's why I don't trade Apple, Netflix, Priceline, Tesla, and that ilk that are over $100 a share, because for the price action I can get a much better chart at a much lower price. And if you do trade the cheap charts, they need to look something like this. Here's one that's more my favorite type, MDU Resources. The ticker, MDU is the ticker on this, and what you can see about this, when I have a hammer at the bottom and it led to a nice cut breakout that kept running on up, a nice 45-degree angle. One of the patterns that you may want to look for in your MetaStock platform is what I call an acceleration ramp. And no, there's no magic indicator that tells you how to trade. All that stuff is for the birds. You can't outsource your thinking to software. You use the chart software plus your brain to make correct trading decisions. You do not try and outsource it and buy some fancy red arrow, green arrow indicator that magically makes winning trades for you 99% of the time. That's what we call magic beans, or BS. Professional traders were all about price, number one, and volume, number two, and that's it. We add a sprinkling of our candlestick patterns and momentum breakout signals to help us make better decisions, but it's ultimately all about your P&L. You use your charts to get into your trades. Use your unrealized P&L as the key exit indicator. Any of you are professional traders, we're nodding your head yes. All the amateurs are saying, hey, I thought this guy was going to try and sell me some indicator. No. That's not how you actually make money as a trader. You make money as a trader by buying into an uptrend, selling at the first sign of trouble, using tight risk management, strongest charts, and that's it. You don't need a whole lot of this hogwash that they're trying to sell you out there in the industry. A trader's advocate, because I learned the hard way by having gone down that path back in the 90s. That's not how you make money as a trader. You make money as a trader is tightest charts, nice clean trading breakout ranges like these, really tight stops, and adding to winning trades with position sizing. Now, how do you add to winning trade? I use roughly every 2 points. So let's say I bought above, say, 20.50 on this first move above this large candle. Where would my next long trigger be in MDU? This is the audience interactive part where you type in an answer, folks. Oh, he's actually going to be interactive. It's not just some guy talking about charts. I used to be a corporate trainer for the Ford Motor Company, Rockwell International, McDonnell Douglas, Chevron, Kraft Foods. I used to do a lot of training for a lot of corporate clients, and so I've got a professional interactive adult learning theory background, I like to teach people by having you, if I was doing a live seminar, I'd have you turn to the trader next to you and identify, if we bought 20.50, we scale in every 2 points, the obvious answer for a scale in would be, and Gary's got up at 22.50, so that would make sense to buy into it. So if I do 100 shares at 20.50, I'll buy another 100 at 22.50. I won't go in, let's say I fully intend to go anywhere from 300 to 500 shares in my swing trades, but I don't throw it all at the market in one fell swoop, because, you know, odds are maybe I buy right here 500 shares and then I get stopped out, and then it runs without me. Really bothers me, to be G-rated and polite. So after having done that a few hundred times, you learn that that's not how you make money as a trader. What you learn is, instead, you do maybe 100 shares, and then if you get stopped out, you do another 100 here. Okay, it's going to scratch, I'll let it ride. It runs up, another 100 there, okay. Pulls back, let's say I chicken out, I take my money and run it a break-even trade. Okay, but the fourth time, it's a nice breakout. I do 100 shares there, and now it's starting to run, add another 100 shares there, and that's the money play. But it didn't cost me hardly anything along the way up to make the money. And that's one of the things that you want to do as a trader, is make sure that you have a very keen focus on the P&L management side of it, not indicator fascination, or as my colleague Tony Turner would call chart spaghetti. You don't need a bunch of squiggly lines to make money as a trader. You just need strong charts and intelligent risk management. That's my voice. That's why so many tens of thousands of traders trust me the last 16 years now we've been in business, right? Award-winning and all the rest of it. Well, I'm grateful to all of you who found value in working with me. I want to paint a really clear picture of the type of charts you should be focusing your energy on and the difference between this and what you may currently be trading. Let's do derivative options, collar, bull put spreads, and blah, blah, strangles this and that. No. Fool's gold. I call BS. Don't do a lot of derivative hokey stuff out there. Trade the best stock charts. Go back to the basics. Okay, I'm old school. I trade what works. Now this is an example of a misbehaving chart, Altria, ALTR, the ticker, I believe. Altria, it's up and down. And one thing that you want to look for is when you see what could be an uptrending chart, at the first sign of trouble, if you see a bearish engulfment, even one or two, that tells you to get out. If you see a hammer, though, that may be decent for a pivot play. But overall, this chart is inferior in texture and composition to some of the previous charts we looked at that have much better breakout price projection. Okay, like this one, the MDU, IM Gold, Hawaiian Electric, Core Mining, right? Those are rock star charts. Anything less than that, you start treating with a little more suspicion. Like interviewing employees for a job. If there's any, then you check references, and then if you start to see any red flags, you put them on probation or don't hire them, right? Well, as a trader, you want to hire employees or hire charts that are most likely to make you money. And the way that I do that is I look for signals and momentum. We're going to flip to live charts in just a minute, but I wanted to go over these ones I've captured first so we can look at some of the core trading patterns quickly. Anyway, you have a nice wide range candle. You go long above bullish cup, wide range candle, go long 50 cents or so above the high of that candle. Use an initial 2-point stop on swing trades and a scale-in trigger of 2 points. Okay, 2 points or so for these $20 to $70 a share instruments makes sense. Here we have another bullish cup that broke out to new highs, so that makes sense. Here's another one, NiSource, or NiSource. I have no idea how the correct pronunciation is, but the ticker is NI. Not to be confused with the Knights Who Say Ni from the infamous Monty Python and the Holy Grail epic British comedy movie. But this is the stock chart that goes Ni. And I like using a little humor. Anyway, inconceivable for the fellow Princess Bride fans. We have a nice wide range candle that keeps going up. It's stalling. Okay, we have another big candle, story of buyers in the house. But you still didn't trade it. You got another shot at it. Hopefully you took the third shot and you're off to the races in the money. But oops, now we have trouble. Big red candle, sell under any large significant outlier candle, right? You can always get back in on a recovery play, whether it's a pivot or a continuation. The main thing is this chart worth dancing with? Is it worth trading with? And absolutely, it went from 19 to 24, so it's got a 5-point range and certainly makes sense in this trader's eyes to buy up at new highs. My biggest money, again, you can see thousands of real money trades captured at my forum at tradingtalk.com, which I don't allow anybody to post on anymore. I closed the forum, but I still keep an archive of real money trade examples there. Anyway, or at least hundreds, if not a couple thousand real money trades. What you'll find is, sorry, there always has to be somebody calling. Anyway, but I won't get that. Whenever you find a nice breakout in progress, what you're looking for is a sequence of new buying volume coming in, and this is where volume comes in as a confirming technical. Do you notice, please, on this first leg of the breakout, volume started to increase? Okay, that tells you institutional accumulation is in place, but then it paused for a while. And the mechanics of real money trading is oftentimes used to be I would keep it on the radar, and then if it stalled, I would just say, well, forget it, there's other fish to fry, and I go on to the next chart. But what I found is my trading success rate increased, and what I found my hit rate increased is keep it on the radar for up to 3 weeks, maybe even a month, and if it does after a week or two of congestion, then start to take out new highs, which often it will. Kind of an expansion, contraction, drop, expansion again. You get a cycle of entries and exits over and over again. So looking for the best of the charts is a big way that you can get things started the right way. Now here's one of the charts that I like best is NVDA. I've been alerting my traders to this since right after this gap, since late February. I was telling my traders in my various alert services go long NVDA starting late February. It's since gone up, 10 or 12 points or more. What got the party started was a high volume gap up, right? A gap, or in candlestick parlance also known as a window. That's institutional buying. They're so excited, like buying things on eBay. I like to buy vintage things on eBay. And anyway, the point is they get so excited about buying, they bid it on up to new highs, expansion, contraction, or rest, another expansion, another rest, little pullback. Then they start all over again with a whole new big cycle of buying that's well underway. I screen capped these back on the 16th, which was just a week ago, just a week and a day ago, last Monday. We're going to flip over to live charts now in just a second. But I wanted to go through these screen cap charts so you can see the setup before we see how things work out, right? But anyway, minor gaps usually continue. Here's another minor gap of less than 10%. A 3-point gap on a $30-ish stock is a minor gap, and it continued to attract buyers even this past week as well. So do yourself a favor and narrow the focus of your trading to mainly focus on minor gap continuations, because those are the single strongest chart patterns you'll find, right? There's a lot of morons out there that say, fade the gap. If it gaps up, it's going to fill the gap. Hey, only if it's like a 30 or 40% gap, but if it's a 10% or less minor gap, they almost always continue in trend, and that's the type of chart you want to hang your hat on and put on a trade in, because those are some of the best big money real trades that you can do. So minor gaps tend to continue the vast majority of the time. So ignore anybody and get off their email list if they tell you gaps fill. It's a gap reversal strategy because gaps fill all the time. No, I have institutional clients. I've had Wall Street guys come to my seminars. We all say the same thing. Gap runners are going to be your best money trades. You're always looking for gaps to continue, gaps to continue. It's not to say all gaps continue 100% of the time, but usually they do. Here's an example of a gap down that continued down for 3 weeks before a reversal. Okay. Anyway, what do we see here? Well, we see some noise here. If you're in doubt, which I would be seeing, if you were kind of yield the passage of time. These aren't the droids you're looking for, believe. That kind of chart you don't want to fool around with. It's telling you nothing, right? Chop, 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 chop. All I care about is new highs, right? So the instant it starts, okay, now it's starting to get interesting. It's at previous resistance, and now it's starting to break out. Now we've got permission to play with it, right? Now it starts to run on up for us. As a professional trader, you're always in the business of extracting money out of the markets and doing so on your terms in a way that makes sense for you personally, with your personal time and money management skills brought to bear, but solving the puzzle of the market the best you can. And I think one of the best ways you can do that, at least in entries and exits in our current markets, which have been kind of down and choppy this year, is make sure you trade the outlier or the strongest high velocity, high momentum charts, right? And as you're scanning through those in your MetaStock platform, make sure that you're looking for those charts that have this type of texture. So just scrolling back through some of the charts here we've covered, you see that they all have clean, wide range breakouts, right? Those are the easiest ones to potentially make money with. Anything less, you're trying to outguess the market and, oh look, here, because what you find is a lot of these bogus educators who don't even really trade, which is most of them, by the way. Yeah, you have my word on that too. I know this. I speak with a lot of the people in the industry. Most of them haven't even traded since the dawn of time, or they're failed traders. They're not even real traders in the trading education space. Make sure they prove that they can make real money winning trades with brokerage P&L screen caps. That's a huge differentiation point. Plus video testimonials from traders at their seminars, like I show. That's one of the things that can help you quickly detect the BS in the education community is, do they have any preponderance or examples of real money trades they've made, yes or no? And if the answer is no, then buyer beware. Why on earth would you trust anybody with strategies to help you make money or potentially learn from to make money as a trader if they don't have any proof that they're even what they say they are? It's just amazing to me. It's mind-boggling that you guys would trust people on the internet who don't have proof that they trade. So anyway, I mean, that's just my pet peeve. That's just me. But one of the things that I think will help is if you do take a look at examples of real money trades. Okay, now let's take a look at some actual live charts here using our MetaStock platform, and we're going to start off with that core mining one. Relatively cheapy. It started to fade back. When in doubt, stay out. Like, you would never buy here. You'd only wait to buy up at new highs above a safety buffer above the previous high. And one of the things that I think can help you is, you know, when you're looking at, let me find some examples here. When you're looking at making trades, one of the most important things is to avoid false breakouts. So part of every trader's approach is you should always have some kind of false breakout expectancy, because if you've been caught by those a few thousand times, you learn after blowing up a couple of trading accounts not to do that. And the way that I do that is I use a simple price action filter, roughly 50 cents above the high. So okay, here's the MDU. That's the one that I mentioned earlier, and it's ran up nicely from the example back here. Earliest long, again, this is not a trading recommendation, but the earliest I would buy this would be 22.50. Back in my early days as a trader, I might buy 22.10, or the instant it pokes its head above resistance, hey, I'm in because I don't want to miss out on a run. What I found out the hard way is oftentimes you'll get in on a what looks to be a healthy breakout, then it pulls back and stops you out, and then it runs without you. And it's really frustrating because directionally, big picture, you were right, it was a long, but trading-wise is a completely different story, right? Because you got stopped out because you got in too early. Good professional trades, and I've done so many of them. One of the things that I found is in my early days, I would think that you want to get in early to avoid missing a run, and then give it room to run and let your winners run and all that kind of nonsense that doesn't work. What I found was it's not early entries, late exits, it's the exact opposite. To make money as a professional trader, my most effective strategy that I've done with lethal effectiveness is late entries, early exits. So it's not to say you get scared or panicked out of a trade, but at the first sign of trouble, you exit the trade. On a swing trading chart like this, a good visual pattern is the loss of 2 red candles. So here, if you're swing trading long here, I'd be fine if I had bought it, say, at 18.50 and sold here at 21. That's fine. It's 2.5, maybe up to 3 points or so. But a loss of 2 pivot candles, you see there is no sign of a pivot there. There's no shooting star. There's no bearish engulfing. There's no voice of the candlestick saying that you should be selling here. But from my standpoint, if I see a small followed by a large whole real body red candle that then loses support under that second red candle, that is an exit. That's a good place to pin the trade or clip the money out of the trade. I can always rebuy if it takes out new highs up at 22.50. Right? You don't want to be in trades longer than necessary. You want to be in trades just long enough to make money and then walk out of Wall Street with the money intact. So 2 red candles or 2 points, whichever is smaller, is a really intelligent place to get out of a trade, right? And if you take a look at the texture here, to zoom in just a little bit, you can see 2 red candles. Now see, this one wouldn't have got you out, would not have gotten you out because it had 2 red candles, but it did not lose support under that second red candle. Here we had 2 red candles and it did lose support, so for that reason I'm out. Bump, 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 bump. Now I'm not Mr. Wonderful. I'm Mr. Amazing, and the way I'm Mr. Amazing is one of the chart patterns I want you to look for is acceleration ramps, and that's simply where you have a steady uptrend that then matures into a wider, sharper angle breakout, and you buy up at new highs above that. That tells you you've got institutional accumulation at work, at play, coming into this instrument. So you see a steady uptrend continuation, and then you got an excited hockey stick type of breakout. It's what I call acceleration ramp, breakout of new buyers coming in. So this puts it on the radar. It has my approval for trading up at new highs, but I'm not going to trade it yet because I have these two red candles. So we don't try and outguess the market by trading pivots. We just trade breakouts correctly. Or if you do trade a pivot, make sure it's after a hammer or another, easily observable, classic, valid candlestick pattern that makes sense. You see what else I can share here with you. As we take a look at some of these charts and what differentiates or distinguishes these from other charts, you'll find that they all start to have some similar patterns in place. And notably, you've got a 45-degree angle breakout with wide ranges. Now, when you see these charts that are big makers and then they start to roll over and go south, I don't go short these because often they'll consolidate, stall, and then keep running on up again. But I do take profit on a loss of two red candles. That'll get me out of a trade. So with the potential in these types of charts, you want to really hone in on the nuances of the candles and what they're telling you. One of the patterns that pops out to me as a professional trader is I'm always looking for the height of the whole real bodies of the candles, and it's a story of buyers or sellers, right? Now here we had a bearish engulfment that did drop a little bit, but it came back to life. It's kind of slowly trending up, but the main story of recent price action is, look at it like a tug of war. Who's winning the battle? Well, I guess price action is very, very minor buyers, but big picture, the candles, if you look at who the big candles are, they're mostly big red candles, right? Like this one especially. It's a big story of a lot of selling pressure that kind of put a dent in the price action there. So always be looking for, you can zoom in really nicely, just use the plus and minus buttons on your MetaStock platform, and you can see during the breakout, it was mostly green candles. We had a bearish engulfment. It dropped a little. It finally came back to life above resistance and kept running on up several points. But here at another bearish engulfing, that's another rest spot in the trade setup. And here we have a big honking red candle. So that would have me nervous long, and I'd be selling likely today because it's starting to move down after a big run up, right? So look to just intelligently do that. And there is no special magic plug-in indicator, Ken's magic candles or Ken's magic acceleration ramp patterns and all that kind. You don't need that. All you need is your brain, right? That's kind of the best software. In addition to the charting software, is use your brain, right? That's all you need. Kind of like a show me, I forgot who the famous classic quote was, but all I need is a good ship and a star to steer her by, and that's what you need as a trader, is a good platform and a good sensible approach that works when you're looking for your trade setups. Another pattern to be on the lookout for is the texture of candles as they're reaching a potential exhaustion area. If you see a nice big breakout, that's nice, but if the whole real bodies start to get progressively smaller like they did in this one, Annaly Capital Management looks like, you can see that sure enough after the candles went from large candles, like mama bear, baby bear, mama bear, papa bear, then itty bitty tiny newborn bears, little teeny tiny flat melted candles, that told you buyers are running out of strength, and sure enough we had a bearish engulfment there, which led to a drop. So if you're in a long trade, my point from a professional breakout trader, I'll tell you, I've done so many millions of dollars worth of trades, hey, I know how to trade these things. Once you start to see this flip from what looked to be a great trade at the time, and it's starting to run up, but then it starts to show a series of small candles, park a stop, put a trailing stop to lock in a little profit at least right under support, as soon as you see 2 or 3 small melted candles after a sequence of large momentum candles. These are good. That'll get me into a trade. So let's say I buy there, but it starts to go up, and I see these are getting smaller and smaller, and I see a bearish engulfment, I'll get back out there for a slight in the money or maybe a little better than break-even trade. Okay, and you'll find that the difference between at least all the thousands of traders I've worked with since 1999, the difference between the biggest money traders and the people who are the biggest losers is simply the size of their stops. The best traders have the tightest stops. Make sure you have really, really tight stops as a healthy part of your breakfast. Make sure that you trade, you know, if you want the force to be strong with this one, make sure that you're trading the strongest. Sorry for all the Star Wars analogies, but hey, I don't have Castle to watch anymore, so looking at classic movies. One of the things you want to start looking for are the trade setups that make money, and be able to do that on your terms in a way where you're, you know, taking a look at a sequence or a series of trades that adds up for you, and manage based off your unrealized P&L. You know, there's no shame in making small real money trades a healthy part of your diet as a trader. You know, one of the things I found is, you know, it's much smarter to make $1,000 with, say, you know, 5 $200 trades than try to make a single $1,000 trade, because that lets you take small stops of $50 to $80 along the way for those charts that you're wrong in. For the charts that you're right in, the ones that do have spectacular big money breakouts that are able to run up at least a few points, you know how to trade those. So here we've got that Hawaiian Electric chart. It's recovering, starting to come back to life. I'm interested in it up at new highs, minimum 24.50, to see if it's able to break out and continue. What I like about this chart, despite the initial pullback here, is the ratio of green to red candles is largely in favor of the bulls, right? We've got largely green candles in charge. It looks like a ticker tape, you know, a Christmas tree light with red, green, red, green, red, green, stay clear. But if it's, you know, 70% plus green candles in an uptrend, then you want to take the shot, right? You want to take the trade. So one of the things I found, at least in my own trades, is you want to be able to visually differentiate between those charts that run and those that don't. My favorite chart in the current markets is NVDA. Applied Materials, kind of a second chance. It's also running up in sympathy, but one of the chip makers, right? Graphics. Anyway, minor gap continuation. Back when I screen capped the chart in the slide deck, it was back here. Since ran up 3 points as of today, right? Taking out new highs. Minor gaps that continue are going to be your best real money trade setups. And the more you can do that in and out, you know, on your terms in a way that makes sense for you, the better you can do as a trader. So make sure that you're focused on those charts that are most likely to make money for you, and the ones that, and the reason I keep talking about making money is, you know, when I do my Money Show appearances, I will say, how many of you trade to make money? And only about 2/3 of the hands go up. Well, what are the rest of you doing it for? Oh, it's a hobby. You want to fun. I'm in it for the money. I want to see as much money as I can grow in my accounts, in my swing and my day trading accounts. And the way that I do that is make sure I have really tight risk management. Let's say if you're in a setup and you've got some unrealized P&L, some slight green and some slight red, where do you manage the trade from there, right? This is one of the earlier real money trades I was doing in my IB account. If you're in the money a little bit, that's good. Nurture those trades. Build on those winning trades, right? If you're out of the money a little bit, be cautious. And if it starts to flip red, 50, 100 bucks, get out of the trade. If it starts to continue on up, add to it and build the trade, right? And as you look at how to make money in the markets and wherever your P&Ls are, make sure that you keenly focus on the unrealized P&L as the main lead indicator for your trades, right? There's nothing wrong with making a few $100s the hard way with a handful of small trades, you know. Or if you have trades where you got one healthy trade, you may find, by the way, that this is the saving grace of position sizing. These are real money trade examples. All pretty small quantity, but I scaled into this one. It made $300 of the $500 that I made in this trading day. Not a handful of, you know, little $50 wins. That's in blue, and the stops are in red. There's $11 a buck, $2.50, whatnot. But the position-sized trade was the one that made the lion's share of the profit for me. The trick is you don't know ahead of time which of the ones is going to be the one that runs. So you got to play the field, maybe a dozen different instruments. The one that starts to run is the one you start to add to or build a trade in, right? But I think it's, and here's another good example of a real money trade day with a small stop. And these are all the trades I made in that day. Itty bitty share size. I still made almost 500 bucks net profit trading under 35 shares. Make that, in NLP, we'd call that a visual anchor. Now let me just ask, how many of you, a show of hands, or just type in the letter Y if you think this is important? When I survey my traders, I get over 92% say yes, but response bias aside, let me know, how many of you think it's important that before you spend money on plugins or educators or all that kind of stuff in the systems, most of which is a bunch of baloney BS in the industry, they have to prove that they're actually real traders. That's kind of my big message for the day, for the lifetime, is only back as a former corporate training consultant, I used to be known as a consultant killer because I'd ask pointed questions that would disqualify the vendors from being considered for contracts with my clients. And similarly, I put that out to the trading industry. You guys need to only learn from people like me, the few unicorns out there, rainbows and puppy dogs that actually prove we really trade. I think, as you're looking at developing a trading system that works, or potentially works, even if you have some stops along the way or you're half right, half wrong, you still want to come out smelling like a rose, making a few $100 for your trouble. So I'm still in the trading education industry because I'm not out there trading, 10,000 shares at a time and so forth. So I'm still small ball trading, but I figured it out, and that's one of the things I think is helpful. And yeah, Bill, I show examples. Let's see. I have some from, I need to post more. I know people have been asking. There's some from September 2015, right? So yes, I do have some from after 2011. I know I need to start posting more for this year as well. But one of the things, if you make money, and this was me trading on the market sell-off back in August, the inverse ETFs, right? One of the things you want to do in your trading platform is you're looking for breakout patterns, is look for the difference between these that continue to run. And look at this. This has the texture that I talked about. We have large whole real body green momentum candles that attracted, like a magnet, additional institutional and speculative money flow, lifting share price from 40 to 45 a share. And again, to zoom in on this in your MetaStock platform, just click the plus button. There may be a keyboard shortcut I haven't yet figured out, but the plus and minus to zoom in and out, which is a really neat feature, lets you instantly scale and see which, what's going on in the chart. It's still healthy as of today, right? It's still healthy. I'd get out of this trade if I see 2 red candles or a loss of 2 points after the breakout. But this type of chart, if you go back a few months, you can see just how healthy that chart is. Back in August, it was a $20 share stock. Now it's a $45 share stock. Now, I would not hold through this kind of a pullback. I'd get out at the first sign of trouble, then patiently wait and rebuy on the first breakout, maybe a scratch trade, then buy again and ride, and it's in the money. And that's the type of chart that you want to focus on in your platform as you're looking for how to trade using MetaStock. So, you will find the answer key to the market is often there. And oftentimes it's been, like Dorothy would say to the Wizard of Oz, there's no place like home, and all you had to do was click your red heels. Well, one of the things as a trader is click the red heels of the charts. If you see two red candles, or you see a dragonfly, or a gravestone doji, or bearish upper shadow, tweezer top, a shooting star, whatever you see here, that should get you out at the first sign, not the second or third or fourth sign of trouble. So when you're in a winning breakout, use any reason to get out of the trade. The better you get as a trader, the more, I won't say you're not nervous as a trader, but you're very selective to get out quickly at the first sign of trouble, because from experience, you've been burned before from trades that look good at the time and they instantly turned against you, or they went up a little bit and then turned against you, and just out of comfort you decided to let the trade ride. And I've done that, and that's where I've lost the most money as a trader. I'm a real money trader. I can teach the difference between what works and what doesn't. One of the things I found in my own trades is the biggest money trades that I have made in my life, of thousands of real money trades, tens of thousands now, 16 years I've been trading, the biggest money trades always felt early to exit. Always felt, really, the trade's over, I'm done already? And sure enough, if I waited any longer, it would have crashed and burned, thankfully without me, because I got out while the getting was good and I made my profit. So that's one thing. You have my word. This is, if my life depended on it, and I was telling family and friends, as well as all of you who are, trading colleagues and fellow traders out there, make sure that you get out at the first sign of trouble, because you can always re-enter later. Don't worry about the commission. Worry more about your profit. That's words to live by. When in doubt, get out. There's always a new opportunity around the corner and plenty of other charts to work. Here's another one of the gold miners that I've been calling long since February, since the first rise in gold. Now gold's been softening up lately, so personally I'm going back to cash in my gold trades. Mainly ABX. Barrick was one of the ones that I was in. But anyway, the gold mining sector is starting to soften up and chop. So now's a good time to get off the boat with these charts because they had their run. Now it's oil's turn, right? Oil and crude instruments are starting to pivot. But here, if you look at the texture of this, you know, it's a story of Chop City. Nobody knows what's going on. It looks like, I don't know, some kind of a puzzle out of a game magazine. So that's not good to trade. That's good to put a trailing stop right here, say 43, stick a fork in it, it's done. If you're long, I'd be completely, again, not trade recommendation, but if I were long AEM here, I'd be selling it all right at 43 at a loss of this congestion box. I can always rebuy up at new highs. Brings up another interesting caveat. 9 looks expensive to all of us professional traders. And the things that I have taught tens of thousands of traders in my industry articles back at Active Trader and Stocks and Commodities and my Money Show and Traders Expo appearances and live seminars and all that kind of stuff. The fame, the fortune, what am I going to do with it all? Is don't buy 9s because guys like me are selling to guys like you at 9. Right? 9 looks pricey, so stick a fork in it. Do not buy anything with a 9 in it because that looks expensive. It's just kind of a psychological price action barrier. To buy this instrument, I'd wait till it breaks over 50, but I would not buy between 49 and 50. And in fact, it stalled right at 49 because in anticipation of that. You know, a lot of what I teach people becomes self-fulfilling prophecy because I reach so many traders worldwide. It's great having a big audience. So I'm not yet on the cable channel anymore. We're up at the 49 region, so that's rich, and that's why it's starting to drop here because they're not so sure. So I tell the world's traders, sell 9s, sell 39, sell 49, sell 59. So don't buy because guys like me are selling to the retail crowd anything near a 9 because that looks pricey and it looks expensive. It's another one of the tricks of the trade that the guys who don't really trade that are educators don't know about, right? And they can't teach you the mechanics of P&L management. But one of the things you want to do is make sure you know these nuances. And, you know, for Pete's sake, if you see a shooting star, sell a loss of the shooting star. If you're in long, you know, I learned from Steve Nissen how to trade candles because they work. I'm not just randomly looking at this. You can see there's another shooting star. Sure enough, it dropped after that for 2 weeks. Here's another shooting star. It dropped for 2 weeks after that. Here's one of my, you know, Ken's Momentum large green candle at the right side of a bullish cup. And sure enough, it ran up, you know, 7 points after that. But because we're getting near a 9 and it's starting to consolidate and drop, 2 red candles, a loss thereof would be a good reason to exit into this day. If you hadn't already done so, I would use a loss of the nearest whole number at 43 to get out of the trade. Brings up another good trading point is make sure you are using whole numbers. For example, the shooting star occurred exactly at the 39. Okay, I'm not going to draw a line on it, but anyway, 39 was the exact resistance here. Now, not only that does that prove out my concept that 9s are expensive and people sell 9s like they did at 39, they sold it. At 49, they sold it. And again, I just randomly pulled this up and looked at it, and that's what popped out to me. I hadn't planned on that for today. I don't cherry pick charts. I pull up, you know, live charts that actually work and then teach you all how to deconstruct it. It's kind of reverse engineering the right way to trade the markets. Well, anyway, at a shooting star, you had a whole number, and increments of whole number often provide resistance, and it was a 9, so that's why it sold down. When it did finally come back to life, above the 40 would be the earliest I'd go in long, I'd say 40 and a half. It did continue to run. Now it ran all the way up to 49 or so and starting to drop. So make sure you're using the candles, the story of the candles, the professionalism, the integrity, the authenticity, the intelligence, strategic entries and exits that make sense for your trades as part of an intelligent, well-rounded approach. You have all these people who are fumbling to teach traders with a lot of derived, made-up fiction about how to use various oscillation indicators, and then they cherry-pick charts that happen to support that it's faulty. I used to be a corporate statistician, and I'm a certified quality engineer for Ford Motor. A lot of that stuff out there is complete and utter fabrication. No corporate statistician or quality engineer, you know, like me would give it any merit, which is why I'm so down on most of the educators, because most of what they teach is complete fiction. All that matters is variation, price action, entries and exits using the strongest charts, and very tight risk management. The rest is a lot of hoo-ha, so to be polite. So make sure you're trading the best charts. And that's the good news, is you can get rid of all those oscillation. I need squiggly lines crossing all over all these lagging indicators to help me use my brain. Hey, no, don't be that guy anymore. Stop it. Stop the madness. That stuff doesn't work. You don't need Fibonacci's. They're magic. You don't need Elliott waves. It's about, you don't need all that stuff. All you need is price action and candlestick patterns and a good healthy dose of risk management and price action pattern recognition skills, and you're off to the races. At least that's what's worked for me. So, if you see things that look like a hammer, you see things that look like two red candles after an uptrend, you see a nice minor gap that continues, those are the type of charts you're going to make part of your strategic approach for trading. And again, in context, when you're looking at the longer term charts, always look for bullish cup breakouts, because breakouts above new highs, false breakouts notwithstanding, usually continue to weather the test of time. So draw horizontal lines on your charts, use that as the entry trigger, 50 cents above that. That usually makes for a reasonably intelligent swing trading entry. So for example, here, that's the previous high is right at where? 40, because I told you people like me sell to people like you, meaning the retail traders. I apologize if there's any Wall Street professionals out there that crowd, but people like us professional traders will happily sell to you at 39. If I'm long from 34, 35, I'll happily sell to some retail trader who doesn't know any better at 39, take the 4 points profit and run, because I'm in it to make money. So if I'm in long, I'll be selling to you up here. Traders who don't know how they're trading, 39, it's going up, let me buy it. And then you get stopped out. And then you try to buy a bounce because you're trying to buy bounces. Really? That doesn't work. And you get stopped out again. It's bouncing again, I'll try again. Yeah, you get stopped out again. You say, I'll forget it, it's not going to do anything. See, I know it's going to drop. And then it runs up 8 or 9 points without you. So don't be that guy. Learn the difference. All these kind of I won't call it secrets, but the mechanics of professional trading and price action that you can get at using your MetaStock platform by just carefully, intelligently looking at the difference between, see, like I said, 40, increments of 10, decade values are sell triggers. That's why we don't buy this here now, because it's likely to run into resistance. Earliest long would be 40.5, maybe 41. But does everyone see that? They were selling to you, or the crowd, I should say, at the 9, because 9s are expensive. Proof of concept, it works. Then they drop it all the way down here to 30, then it comes back up to 40. The right play in this would be a new long up here, up new highs. But be cautious. Be slow to enter. Try and make as much money as you can in your trades without dinking around with this stuff and over-trading choppy, cheap charts. Don't try and be patient, too. One of the things that I found with so many traders is they're impatient. Yes, this ran from 1 to 4. Well, that's nice, but it's a horrible chart now because nobody's coming in to buy it. So don't you be the person who thinks you can make a difference and, I'll go do 1,000 shares, and then it drops a point and you're down dollars, right? I've lost the most money trading cheap charts, so I found the hard way not to trade those. Just say no, right? I've made the most money trading instruments with better texture and better intelligent, sustainable patterns like NVDA, right? That's the rock star chart. Not to say it's going to keep going up, but it looks like it will, and it's certainly worth considering up at new highs. But that's the type of chart you should be involved with and engaged in. I've been calling it long since the first gap here, and it's ran up, 15 points since then. And that's a good reason why, is because it's a nice, well-mannered minor gap that continues intelligently and could do very well for you financially if you're trading it. Does everybody understand this? I know my personal role model for teaching is my colleague Brian Tracy, who I've done 2 interviews with that are on my website at Daytrading University. But he's the finest educator in the world, in my opinion, and I've learned so much from Brian Tracy on how to be productive, which is why I have a network of over 70 websites and tens of thousands of traders, over 32,000 traders worldwide with me. And I think one of the things that helps is understand clearly spoken, easy to understand, easy to implement strategies that are relatively consistent that work in any market condition without the need for, and that's why some people, or I should say a lot of people now, find my training a refreshing breath of fresh air, is because, not only am I a real money trader with proof, I'm a real genuine trader. This is in my Fidelity account. I like to trade my Fidelity Sapphire up to make money in my retirement account, so that's from a few months ago. I need to post some new ones in there too. I did in my live Saturday trading week ahead. This last Saturday I'm long UCO, and I posted a live real money trade. I was up a few $100 in that to answer Bill's question. So anyway, those are the type of thinking, and hopefully I can, be part of your success and part of the answer. I do not sell software indicators or magic bullet scanners or all that kind of BS, because I don't think it's helpful. I think that's part of the problem, not part of the solution, because people buy what some vendor did a slick job of selling them, and it doesn't work out. It doesn't have reliability and validity to use quality management metrics or statistics. It had some cherry-picked examples that they used to sell it to you, but when you try and do back testing or proof of concept in real money trades, it falls apart. And that's why I'm a big skeptic of the trading education industry. Only learn from those of us who are real money traders with proof that we really trade, and learn patterns like these that can really do well for you. You know, as you're looking for differences between charts like this that are choppy and charts like this that are nice rock star breakouts, or ones that actually have potential that can run for you, like this one. That's kind of the biggest leverage move up is this CDE chart, right? Those are the type of charts you want to play with. I mean, just, I don't know about y'all, but the greed glands get going and I say, hey, but just on 500 or 1,000 shares there. Now this one I did not trade lately. I've not traded the last 2 weeks in this thing. But you see how far it ran up earlier, and I'm keen to see if it breaks over 10 at some point, but for now I think it may do a 50% retracement down to 5 or so, so I'm going to leave it alone. But those types of charts that have the best texture and the best volatility usually make for the most intelligent trading decisions that you can make as an active trader. So with that, let me wrap up with the final call to action, and I run Trade Mastery, so you can see my free weekly. Actually, we're now up over 4,000 people, so epic turnout for my events are the #1 in the whole industry. We just broke the 4,000 mark last week, so I'm pleased as punch with that. Back in a year ago, we're 3,300, now we're up over 4,000. You can just go to trademastery.com and join me for my free weekly Saturday webinars. No credit card required. It's absolutely free, and I've been doing these for so many years and so many thousands of traders registered. It's a lot of fun. So thanks so much for being here. I appreciate it. And hey, thanks, Bill. Yeah, I would absolutely VP with the Don, but I'm not on the list. But thanks for the vote. Let's see, a question from Charles. These have all been, is this for day or swing trading? These are all swing trading charts, so this is all for swing trades. Juan is asking, the institutional money looks for at least 20% in trading stock. It depends. All institutions have different price action criteria for the client account, so it depends on the fund for which they're trading, but that's a good question. All right, well, I think that's about it. Thanks so much, everybody, for being here. And thanks very much to the team at MetaStock. I appreciate their working with me, and it's certainly nice to see all of you here today, and I hope that this helps you make better winning trades more often, more a way of life, and instead of the exception, it becomes more the rule. So thanks for being here. This is Ken Calhoun, and may more of your trades be ones that you can be proud of and shout downstairs and say, hey, honey, guess how much I made in this trade? They say, congratulations. It's nice to get there after years of the other, so hopefully I can be part of the success. So thanks for being here, and I'm going to wrap it up right now. And thanks to our host at MetaStock.
Thanks very much, Ken. Really enjoyed your presentation. We look forward to doing a lot of work with you here in the future. If you guys have any questions about MetaStock, please come visit us, metastock.com. We do have a live chat function. You can chat in, ask any questions about our charting software, etc. If you have any questions about Ken's methodology, I'm sure he'd be happy to put the link to his website there in the chat for everyone to view. Visit him, ask him questions, and again, thank you very much for attending this webinar. And as always, happy trading.